I got a great question from Shannon, who wrote in the comments and asked this. What would be a valid reason to sell a stock? I'm thinking about letting go of Beatrice. Amazing question. Knowing when to sell a stock is just as important as knowing when to buy. And today we're going to go over a few reasons you may want to consider getting rid of a stock in your portfolio. So without further ado, let's get into it. All right, my friends, welcome back to another video. It is so great to see you guys. My name is Ryan Williams, and in case you're new to the channel, here we strictly talk about dividend stocks. And twice a week, I'm putting out videos documenting my own investing journey and sharing with you how to build long-term wealth and create passive income by investing in dividend stocks, with the key phrase here being long-term. That's right, guys. Dividend stock investing is by no means a get-rich-quick scheme. To really rack up enough dividend income to be able to, pay your bills and such, we're talking a matter of years, like 15, 20, 30 plus years in many cases. Obviously, this depends on a myriad of different factors, guys, but one thing that is for sure is that dividend stock investing is a slow burn. And along the way, on this long journey, as I'm sure you can imagine, you are bound to make some mistakes. I know I have for sure, and there's one big one in particular that comes to mind. You guys are gonna throw eggs at me or something when you hear this. So back in the day, guys, a couple years ago when I first got into dividend investing, one of the first stocks I bought and had in my portfolio was none other than Apple. I don't have it today, but back then it was one of the first ones that I picked up. And as you can see from this footage right here, which is actually from one of the very first videos I ever put out back in October 2020, at this time I had about 5 shares of Apple, just under 5 shares here in my Robinhood portfolio, and I probably had a few more there on Charles Schwab. I had 2 different portfolios at the time, and my cost basis for this position, guys, is absolutely unreal. $82.52 per share on average, and at this time, I think Apple was maybe $120 per share. I was up about 50%. But a few months later, guys, I ended up selling out of all of my Apple position. And as you can see from this screenshot here, I sold when Apple was priced at $118.50 per share, which if you've been following Apple at all, which I know a lot of you guys do, it's currently sitting at over $160 per share. So I totally goofed up. It was a stupid mistake, guys. And while I'm glad to have realized some profit from, making this trade, this is an instance where I maybe should not have sold. I probably should have held on to Apple. And this brings us to really the main point in this video, which is trying to determine when you should sell a stock. Now, first of all, guys, let me say this is never an easy decision. It's never easy to sell one of your stocks. And as dividend investors, our objective is to buy these stocks and hold them over a long period of time. And while realizing some profit and locking in some gains feels nice and it's really great, but it's not something that I think one should make a habit of doing too often. More often than not, guys, you will be better served by just buying and holding. To dive a little bit deeper into this, we can look at this study done by Professor Brad Barber, who specializes in investor psychology at UC Davis, which is coincidentally right here in my neck of the woods. I only live about 20 minutes from UC Davis. Anyway, after investigating 66,000 different investors' accounts, so that's quite a bit, he observed that investors with the highest amount of turnover in their portfolio saw the lowest returns, and we can see that from the chart on the screen right here. Now, the group on the left, group number 1, had the lowest turnover and saw the highest amount of returns, whereas the group more towards the right, group number 5, had the highest level of turnover with the lowest returns. So long story short, guys, try and think long-term with your investments and only sell under very objective conditions. The first of which I think is a legitimate reason to sell is when a company cuts their dividend. But before we get to that, I want to invite you guys to join the Dividenders Discord group. Now, for those of you who are not familiar with Discord, don't know what it is, essentially this is just one big group chat filled with now over 450 other dividend investors and counting, and all we're doing is talking dividend stocks and sharing our portfolios, and there's no strings attached for this Discord group. It's totally free. So to gain access, all you really need to do is click the link in the description of this video. It will take you right there and you can join the group. I'd love to see you all in there. Anyway, getting back to dividend cuts, guys, as dividend investors, we often take a growing dividend as a sign of a financially healthy and profitable business. And growing our dividend income really is our primary goal here. So any sort of cut or reduction is not going to help us reach that goal, and it stings quite a bit. And when this does happen, it could mean some financially hard times ahead for the underlying company, in which case you need to question whether or not it's one you want to keep in your portfolio. And this is one of the big reasons it's so important to do some research into these companies before you make your investment decisions and try and identify the stocks where the chances of a dividend cut are not foreseeably high. However, even when you do your due diligence and try and invest in high quality companies, the chances of a dividend cut happening are always a possibility. In fact, two recent examples of this happening came from some actually really iconic companies, Ford and Disney. Both companies cut their dividends in 2020 for reasons that I'm sure you can imagine. And out of the two, actually, kind of surprisingly, Ford is the only one to bring theirs back and just paid one out to shareholders this month on March 1st. And with that, I'd be very curious to know if any of you guys out there have or had any of these companies, either Ford or Disney. What did you do when they cut their dividend? Did you hold on to it? Did you end up selling? Did you buy even more? What moves did you make when you realized these companies were cutting their dividend? Let me know in the comments below. Anyway, moving on, the second reason that you may want to consider selling out of a stock is when something drastically changes on a fundamental level for the business, something that could impair their ability to make money over a long period of time. Like, for example, if Lockheed Martin came out tomorrow and said, we are no longer in the defense business, no more F-35s, no more armored vehicles, no more missile defense systems, from now on, we're frozen yogurt. That's obviously a very exaggerated example, guys, but you catch my drift. If a company makes a move or changes directions in a way that could permanently inhibit their long-term growth potential, then it could be a good idea to get out of that one. Moving on to the third reason that you may want to consider selling out of a stock is simply when there are better investment opportunities on the horizon. And this is actually a reason that I sold out of a stock in my portfolio fairly recently. Now, if you guys are familiar with my content, you'll remember that a couple months ago, I sold out of Campbell's Soup Company, ticker symbol CP, to start a position in Snap-on, ticker symbol SNA, which I felt was a much better investment with more growth potential. Now, just comparing the dividend stats here, guys, we have them both pulled up on the screen. We've got Campbell's Soup there on the bottom. We've got Snap-on there on the top. And Campbell's Soup does have a higher starting yield at about 3.5%. But really, guys, Snap-on has the advantage in pretty much every other way regarding the dividend. They have a lower payout ratio. It's not even funny how much higher the 5-year growth rate is, basically 15% compared to 2.3%. And then Snap-on also has 4 times the dividend growth history with 12 years of consecutive dividend growth compared to Campbell's Soup, 3 years of dividend growth. So they both have different things to offer, but for me at this stage of the game, I'm really looking for more dividend growth and to grow and scale that dividend income over time. Whereas Campbell's Soup, they're probably going to be stable. They're probably going to pay a reliable dividend, but there's not going to be much growth there. And while the difference between these two stocks is pretty clear, at least in my opinion, it was still a tough sell. It was hard to let go of Campbell's Soup Company, but at the end of the day, you have to do what's best for your portfolio. And having said all of this, guys, keep in mind that none of these are really set in stone, and there's also going to be more reasons that you may want to consider selling. I'm sure you guys will have some more reasons of your own, which you should drop in the comments below. But in each case, use your discretion to try and come up with an objective decision on the matter. And if you guys need some guidance or need a second opinion, well, you've got the entire dividend stock investing community at your back in the Discord group. So, and with that said, I really hope all of you guys join the Discord. If you want to, there's a link right here that you can click on. It'll take you right there. And also, if you want to see more dividend stock investing content from me, check out this video right up over here. But at any rate, that's all I got for you. So thank you so much for watching this video. Hope you guys have a great day, and I will see you in the next one.